The Federal Reserve held rates steady on Wednesday and trimmed projections for interest rate reductions this year to a single quarter-point cut. Welcome to Market Insight. I'm Ramzan Karamali. Well, Fed Chair Jerome Powell said policymakers would leave rates unchanged until the economy sends a signal that something else is needed, either a jump in the unemployment rate or a more convincing decline in price pressures. Well, to help us dissect the meeting, we have Head of Macro Strategy for EMEA at State Street, Tim Graf. Tim, thanks so much for joining us. So, Powell said we don't make decisions about future meetings until we get there. What do you anticipate will happen next, though?
Well, the next meeting, they probably will be on hold. I suspect, we've had some promising inflation data in the form of CPI. We've seen some more promising data just now with the release of PPI, which came in below expectations. So we're getting on the right track. But I think the Fed is going to want to be very cautious about timing, not relying on one data point, but maybe getting two, perhaps three more of these inflation reports coming in at a more benign level that confirms that we are on this disinflationary track again. It does seem like we're getting back on track. A lot of things that have been contributing to inflation in past months are starting to really soften up a little bit. So there's a lot of hope here, but I do think they'll be a bit more on the cautious side and wait for a couple more of these reports.
So the fight against inflation, it doesn't quite seem over though, does it? And there is a possibility that the Fed don't cut a game this year at all, isn't there?
I think it's a remote possibility. I think things are setting up pretty nicely for them to go at least once this year. I suspect they'll probably have cause to go twice because, as I say, even though they will be conservative, they will want to see two or three more of these inflation reports come in quite benign. That gives them the scope to do so. And you've seen the rise in the unemployment rate in the last non-farm payroll report, or accompanying it at least. You've seen some softness in some other labor market indicators. And so under the mandates of their dual framework, looking at both employment and inflation, I suspect they will have enough evidence to get going, say, by the November meeting.
What have you made of the market reaction to yesterday's meeting?
I think the reaction was probably bigger to the CPI data. The reaction to the Fed was almost as though it didn't matter. And in some senses, I think their projections, that's really kind of the case. The market has seen at least one data point, and we shouldn't rely on just one data point, but they saw the data point earlier in the day as a reason to sell the dollar, soften up expectations for the Fed, and add in more easing later in the year. And it's not to say they ignored the Fed at all, but the bigger reaction by a long shot came in response to the CPI data, which is much more about future Fed policy as opposed to what the Fed is thinking this week or the last month or so.
Now, next week we hear from the Bank of England. Do you think what the Fed did yesterday will have any impact at all? And if so, what?
Probably not for this meeting. This meeting is complicated because you have the general election coming up on the 4th of July. It was always going to be a bit of a toss-up whether they would cut rates at this meeting as well, just given core inflation is coming down. It's a similar disinflationary dynamic as in the US, but it's coming down a lot more slowly. Wage growth is still very, very sticky in the UK, in contrast to the US, where it's sticky, but it's also coming down a little bit faster. So I never thought this meeting was really in scope. I think it was always about the August meeting. Will they take a page from the Fed? I don't really think so. I think both central banks are poised to ease a couple of times later this year. I don't think yesterday's meeting from the Fed really influences them one way or the other.
Now, you mentioned there the election. Is any of the latest economic data helping any of the politicians on either side?
Probably helping labor if it's helping anyone. I mean, I think the economic data over the last couple of years is one of the real reasons why the conservatives are struggling. Elections taking place against the backdrop of high inflation regimes, even if those high inflation regimes have passed. And in the UK, I think you can make the case that it has passed. Headline inflation is back to 2% year on year, but it doesn't really matter. Voters blame the party in power when they've experienced high inflation. We've seen this in countries around the world, the US in particular. In the 70s and early 80s, you saw this. And so I think the data hasn't been good for the conservatives lately, but it already has been a pretty bad backdrop just given what we've seen the last couple of years. So I don't think the recent softness in consumption or in the labor market data helps them. If anybody, it helps labor, as I mentioned, but that's already they've already got a pretty high base of support anyway, just given some of the longer term factors that I've alluded to in the backdrop.
Tim Graf, Head of Macro Strategy for EMEA at State Street. Many thanks for your time. To dive into these stories and much more, head to Reuters.com.